Welcome, everyone.
Hello, hello. We're just going to give a few seconds to have people join. All right, they're filing in. Very good. All right. All right, what do you think? Should we get going?
Let's do it.
All right, hello, everyone. Welcome to Alden's quarterly update and market review. Today is October 16th, 2025, and we are here again sharing some thoughts and our opinions and outlook on what we see happening. Not just at Alden, because we will give you some personal updates there, but on a few different fronts, we want to let you know what we're seeing as far as markets, different sectors, asset classes, the economy at large, and maybe give you some financial planning tips or heads ups, if you will, that you might be able to apply to your personal situation. So that being the case, let's jump right in because I know Jason has a lot he wants to talk about today. Just for those of you who may not have been here before, or even if a review for those of you have, this is the format for today. The webinar will be recorded, so you will receive the recording probably within the next 24 hours because you did register. So thank you for that. It's during the webinar, it's listen only format for you guys. So you can't participate live, but we do have a Q&A button at the bottom where we will be addressing questions that you may have as they arise, whether you have them now or arise during the course of the presentation. So please feel free to, at any time, put your questions there. We will try to reserve time at the end rather than interrupt Jason as he speaks. Just for the flow of the presentation, but we promise that we will get to your questions. For the most part, we always do. So please feel free to type in as you go, so you don't forget the questions, and we'll address them as we can at the end. All right. Now, before we jump right into the economic stuff, which I know is so exciting, Jason can't wait. We always like to get you involved a little bit. So we start with a couple of poll questions, something light, something serious. So let's bring up the first question, if you wouldn't mind answering the question once it shows up on your screen there. We will wait for it to show up. It says, when do you officially call it sweater weather in Florida? I know we have attendees here who are not in Florida. So for some people, it's already sweater weather. I was talking to someone last night who's from New York and saying it's chilly, and they came down here and said it's a lot warmer. So please feel free to choose an option there. I know I woke up this morning and it was 68 degrees. I'm like, oh, it's cooling down, as my northern friends say. Really? Really? So let's go ahead and answer some of those questions. And then we will pull up the answers. So below 80, below 70, never. Is flip-flops year-round in Florida or only indoors, thanks to the AC? All right. What did we get as answers? So below 70 is sweaters weather. That's hilarious. That one, the big one. We got a few as a never. And I remember that when I went to school up north, at Princeton, after the winter, quote unquote, as soon as the temperature hit about 45 degrees, people were started bringing out the flip-flops and because it was warming up. But okay, let's get a little serious now. A little bit more of a serious question. When you think about retirement, which of these feels most uncertain? Having enough income to last, knowing when to start Social Security, leaving a legacy for family, managing healthcare costs, or just never retiring? So again, there's no right or wrong on these. We're just curious to see where our people are at with regard to these different considerations that we actually address when we do financial planning for our clients. So I'll give you a second. Again, which of these do you think or feels most uncertain to you? All right, let's see what the poll says. Most people having enough income to last. That's a fair one, with a far second place of Social Security and healthcare costs, which are also very serious considerations. All right, very good. So that being said, let's jump right in. Jason, feel free to take it away.
All right. Well, welcome, everyone. Excited to share this with you. It's been a pretty interesting year so far. There's no lack of interesting news as we have gone through this year. But I wanted to start off just kind of where has the market, in terms of most indices, how has it performed so far year to date? And we threw gold up here as one of the main indices just to kind of give some perspective. Gold by far has done the best, up 60%. I'm going to take a deep dive in gold as we get through the webinar. But just so you know, what comes in second place may surprise a lot of people, but that's international stocks. So international stocks are up 25%. S&P 500 is up 15%. And then both bonds and small caps are up 7%. So all in all, if you think about it, pretty solid year across pretty much every asset class. So I think some people, when they see the news and they see all the tariffs and all the different wars and things like that, they think that the market may not be doing that well, but that's certainly not the case. It's doing pretty solid. So let's jump in. I know a lot of, I've been getting a lot more of these questions recently, and certainly something on the investment management team that we're monitoring very closely. But that's what's called valuations, or how is the stock market expensive? Has it gone up too much? Can it continue going up? Those types of questions. One of the ways we try to address that is by looking at what our stock's worth compared to various different things like price to earnings, price to cash flow. You can look at Shiller's PE, which kind of takes a 10-year average and factors in inflation, dividend yields. There's a lot of different ways to measure valuation. This particular one is measuring forward PE ratios. And so it goes back about 30 years. The worst or the highest valuation in the last 30 years was the late 90s. So if you guys remember the dot-com bubble and all the internet stocks when they went up a lot, that was the highest valuation that we've reached in the last 30 years. In fact, I have other charts that go back 100 years, and that was even slightly higher than the Great Depression, or 1929, prior to the Great Depression. Then you had kind of the big run up until 2021, right after the COVID and all the stimulus that came out from that. The market went on a tear, took a big pullback when we went into the big inflationary years of 2022 and 2023. And now we're right back up here again. So we're right back up at that high that we reached prior to the market dropping in 2021, but not yet quite at that high that we reached, which would be over here, the one kind of in the late 90s. So yes, from a valuation perspective, the market is overvalued. However, it is very difficult to pick or to time a market top. Does the overvaluation continue to go up to where we were in the late 90s? Do earnings start to accelerate and kind of reduce the earnings side of this ratio of price to earnings, thereby kind of slowing this growth? So, we definitely keep this in mind. We use what's called a weight of evidence approach. So we're not going to use just one metric to kind of time where we place money. We're going to take a weight of a lot of different areas and a lot of different factors, put it on a scale and say, is this enough for us to adjust the portfolio based off of all the evidence, not just one, but this is valuations. All right, so I wanted to kind of take two charts to kind of look back and say, okay, in past runs, how far has the market run? And have we run too far right now where that it looks like it's going to top? So this goes back just about 30 years. You can kind of see this run right here from 1997 to 2000 went up 100%. The one from 03 to right before the financial crisis in 2008 went up 101%. Then you had a massive run from 2009 all the way up to 2019. That was 400%. And then you kind of get the more recent ones from the 2020 low up to 2022, you went up 114%. And then right now you're up 86%. So certainly, compared to other time frames, 101%, 106%, 401%, 114%, there is potentially some room here on the upside if we look at it between this time frame right here. Now, as I had mentioned in the last slide, the forward PE is pretty expensive compared to its long-term history, but it's not as high as it was in 2000. And dividend yields are actually a little higher than where they were in 2000, which is a good thing. And you had the 10-year treasury up much higher at that point too. So I want to take one step back to go even more long-term. Actually, before I do that, one of the things that we look at from the standpoint of like, okay, hey, you got valuations, you have technical analysis, and then you have something called sentiment, which actually falls into technical analysis. But sentiment is the study of how people are feeling in the market, whether they're feeling optimistic, whether they're feeling pessimistic. And the theory goes, and it's actually got a really good track record, if people are overly optimistic, then that's usually bad for the market. If people are extremely pessimistic, that's usually good for the market. And the logic, even though that sounds opposite, the logic for it makes a lot of sense. If you think about it, if you're extremely optimistic, then you've probably already invested all of your money and there's nothing else left for you to buy. You have no more cash. You run out of demand to push stocks higher. At the same time, if you're extremely pessimistic and you reach an extreme point of that, you've probably sold, or the majority of the market is probably sold. So they have no more stocks left to sell. That reduces the supply, but it also increases a potential huge level of demand, meaning cash on the sidelines. So this is an important one to follow over time. And the market has gotten a little bit giddy, if you will, a little bit overly optimistic. You can see the line right now. This dashed line, anything above that would be considered extreme optimism. Now, we haven't reached the most extreme, but we're still at a pretty high level here. And when that happens, when you get above 66, then over time, the average annual return is 1.27%. So certainly from a valuation standpoint, also from a sentiment standpoint, that warrants some caution in the market. But I do want to step back and go a little bit more longer term, just to say, there are times where the market can go and be overvalued, if you will, or if some people want to throw out the term bubble, you can be in a bubble for a long period of time. So I want to caution our investors to say, hey, the market seems overvalued. It seems like it's run a lot. Should we go more defensive, or should we, some people go on the extreme side, should we go cash or some type of other asset? Well, if we go back, I'm not sure if you guys can see this, this looks to be a little bit cut off, but that's the 1920, excuse me, that's 1932. This is 1929. So that's the beginning of the Great Depression. You can see you went 15 years in kind of this secular bear market. Secular in terms of trend terminology means long term. So when someone says a secular trend, they're talking about 10, 20, 30-year trend. It's a very long-term trend. But so you can kind of see this, the market alternate over time between a secular bear market and then a secular bull market. And then you go here, and this is in the 70s and the big inflation area here. You had 16 years of a pretty stagnant market. In fact, it was called the stagflation years. Then you had kind of the 2000 through 2013, which include the dot-com bubble and the financial crisis. That was a 13-year secular bear market. So, but on the other side, and this is what I want us to focus on, if I take the bottom point in those bear markets and I say, okay, how long did that trend run after it bottomed out? Well, from 1932 all the way up to 1968, approximately, that you had a 36-year, essentially a bull market, a very strong bull market that was up 2,500, almost 2,600%. And I say essentially a bull market because you did have some drops right here, which when you're looking at from a really long-term standpoint, they don't seem like big drops. But when you're in the middle of those, they seem like a really big drop when you're living it out. But then if you look at the next secular bull, it lasted 26 years and went up 2,300%. So that's taken the low around 1974, and that's going all the way up to the high prior to the bear market starting in 99, 2000. So if we take now, okay, let's look at the bear market low after the financial crisis, and we project that forward, and with the time frame that we're 16 years in to this secular bull market, and we're only up 820%. I say only because the last two times we went up 2,575% and 2,300%. So there is potential room if you step back and take yourself out of the day-to-day market news and the things that are going on, and you look at things from a longer term time span. I'm not saying we don't have a potential drop, like that was the pandemic drop, that was the 2022 inflation drop. Like those seem like really big deals, and they were when you're going through it. But when you take a step back and look at it longer term, there is room for this market to go higher. And so there, even though valuations are high, even though short-term sentiment is frothy, while we certainly could have a pullback in the near term, this secular bull market trend that we're in is still alive and still strong at the moment, regardless of the perception of the things that are going on around us. It's still intact. From a technical standpoint, it's still strong. So I point all that out to say, like, when you're using technical analysis, there's a saying that says the trend is your friend until the end. And right now the trend being consecutive up and down in the market, higher highs, higher lows as you kind of stair step your way up until this line right here, the S&P 500 breaks that trend line. That the trend is still intact. And so as an investor, as a portfolio manager, yes, there may be some short-term things that we do and we are doing to be a little bit more defensive over the short term, but there's definitely nothing. There certainly is the possibility that the market could go up much higher than where it is right now. So, well, people are asking, okay, so why is the market continuing to go up, even though we have all this news? Seems like jobs are really slowing down, inflation's starting to creep up. What's causing this market to go up? And this gets a little bit technical. I'll do my best to explain it in a simple way, but it's based. I think a big part of it is that margins are still very strong. Jason, what are margins? So a gross margin is basically for the products that you're selling, the cost it takes to make those products, the difference between those two numbers is your profit margin, is your gross margin. So this black line right here, I want you to focus in on this middle chart. This black line right here is showing that margins are still trending higher. And it's not quite as high from back in 2021, but it's still trending up higher. And the market cares a lot more about profit margins. That's a very healthy thing when you have strong profit margins. So just to kind of break this up and make it easier. So if it costs, if you sell $100 worth of goods and it cost you $60 to everything it took to make those goods, then that $40 or 40% would be your profit margin or your gross margin. And that's close to where we're at. We're at about 38 right now. So what people may ask, well, how is that? How is both operating income margin and gross margin continue to go higher? I think a big part of it is the consumer is still healthy. Number one, even though a lot of people don't think that, the numbers are still showing that the consumer is still healthy, and I have some slides for that later on. But at the same time, I think what's happening is you have kind of an AI boom, if you will, happening inside these companies where their workers are significantly more productive because their workers are tapping in to AI to speed up the process and to do a lot of tasks that would take them a long time. They're doing them in a quicker time frame. And when you can do that, you can keep your labor costs a little bit lower. So that is one reason that the market continues to go up, and the market from a margin standpoint still looks pretty healthy. All right, so if we break down the market and we look kind of like the S&P 500 to the S&P 600, and this actually is as of October 10th. Both of these have bounced back a little bit. This was right after the Friday when it dropped. But still, what you can see here is that the S&P 500 representing large U.S. stocks, U.S. companies, versus S&P 600 representing small U.S. companies, the large caps have outperformed. And this only goes back about 1 year, but if you go back even further than that, this is actually year to date, but if you go back further than that, it has been the case for a while where large cap has outperformed small cap. But if you look at this chart here on the right and kind of take the forward PE versus a 20-year average, all of them are expensive. The most expensive is this one right here, large cap growth. That would be kind of your Mag 7. A lot of the names you hear a lot in the news that they would probably fit in this large cap growth area. They're at 153% of a 20-year average for PE ratios. But if you look at this segment right here, what's called SMID cap or small and mid cap, in kind of the blend core and the value, that actually is relatively it's slightly overvalued, but it's pretty much at its 20-year average. So while there is a big segment of the market, and that includes a lot of the market cap of the overall market overweight, there are sub-segments within the market that still look not too expensive. All right, so if we look from a U.S. standpoint compared to international, You can see here year to date, on the first screen, when I showed all the different indices, I showed just kind of the international stocks as a whole, which is this one. But if you look at emerging market stocks, they're up 29%. So compared to the S&P 500, which is, as of yesterday's close, up 15%. So emerging market stocks are up almost double of the S&P 500, and international stocks in general are up significantly higher than the S&P 500. Couple reasons for that. One, and I'll show you the dollar on the next slide, but the dollar has been declining. If you hold stock that's domiciled in currencies outside of the dollar and the dollar goes down, it makes the stocks in the other currencies, relatively speaking, potentially go up. But that's only one reason. I don't think that's the major reason. As we start the year, so if you look at the blue line where we kind of started the year, the blue diamond here, versus kind of, this is looking at each segment. So the US, Japan, the Eurozone, emerging markets, and then just China specifically. You look at where we started the year versus the 20-year averages, which is the gray line of PE ratios. The S&P 500, or the US in general, started off the year way above its 20-year average. Whereas international, for the most part, either started off at their average or below their average. And so to start the year, this is something that we did with our client portfolios. We started increasing international. We decreased large cap growth. We saw that that was expensive, and we started to increase international. And international hasn't done great over the last 10 plus years compared to the US stock market, but it had reached a valuation that, comparatively speaking, if you look at international stocks versus and their discount to US stocks, they were reaching over 40-year lows in terms of being significantly discounted to US stocks. And so we thought that was a good opportunity. We added to that area. You can see now the valuations have gone up in each one of those as the indices have gone up, but they're still not near kind of their 20-year ranges in terms of their high, whereas the US stocks are near that 20-year high. So all that to say is, I think if you take the whole picture of what you can invest in on the stock side, U.S. stocks seem a little bit definitely overvalued, especially large cap growth. But international stocks actually have a pretty solid valuation. They are above averages now, long-term averages, but they still have room to grow on the upside before they reach kind of their 20-year average highs. All right, so I had mentioned that one reason for the international stocks going up was the dollar going down. And if this is a longer term chart going back to 2007, if you look here from really the financial crisis all the way until kind of now, we're in an uptrend in the dollar. A lot of people don't understand that they think the dollar is crashing, and it certainly has gone down this year. But for now, we still are in an upward trend in the dollar. From a secular long-term standpoint, we are still in an upward trend. Now, we're at a very crucial area. This trend line right here, it needs to hold that. So far, it has held that. It hasn't decisively broken below that, although it has come down and touched that trend line. So that is something we continue to monitor very closely. But a big move this year specifically. So 2025, you can see that the dollar has declined significantly in 2025. Number of reasons for that. Deficits continue to get bigger. I think a lot of people got concerned when Trump came into office, and there was a lot of tariffs, back in April, raised them really high or threatened to raise them really high. There was some fear there. And so there was kind of this exodus out of US stocks and into international, out of the dollar into other currencies. But it's started to steady now. And so that's something that we're watching. Will it continue to steady? Or will it break down from here? International, if it continues to break down, international stocks typically will hold up better in that type of scenario. But even more so than that, gold typically does really well in a falling dollar. So I'm showing you gold here, and this is if we kind of look at just 2025. This is a very long-term chart, but 2025 starts right here. You can see that's that 60% run over that just this year. So gold has done exceptionally well, But I wanted to also take a long-term time frame on gold as well, because some people may think, well, gold's gone up so much recently, can it continue to go up? Well, if you look at its kind of long-term history, you had a lot of inflation back in the 70s. Gold went up for about 11-year period, an 11-year upward trend, and it was up 1,830%. And then it really went sideways for a long period of time, and even down for 22 years. And then starting kind of in 2000, you had a 10-year upward run, up 638%. Then you had another kind of 12 years just sideways trend for gold. But if we take the low of gold right around this area right here, and we go to where we're at right now, it's up 300%. That's a huge run. But at the same time, there is potential, if you look at the last times that the gold made its run, to go higher. And so this is a big part of our clients' portfolios. A big reason why they're doing well this year is because of gold, and that's done solid. And while it has made a big run here recently, and it certainly would be even healthy and normal for it to kind of pull back some here, we still do believe, based off of a lot of factors, there's a lot of tailwinds. A lot of central banks are adding gold. The dollar has been getting weaker. There's a lot of geopolitical uncertainty. The economy has been slowing down. All these reasons, a lot of times, can be supportive of gold. And so we do think that gold does still have some legs to run, but we also think it is a little bit has made a pretty big move here recently, and so we got to be cautious here in the short term. But we think the long-term trend is intact and does have more room to run on the upside. This is a very interesting chart. If you look at gold, basically gold divided by the S&P 500, and you do these types of ratios to kind of compare one asset class to another. And the way we use these for a portfolio management standpoint, we have all the different types of ratios across multiple different asset classes, is to see on our explore portion of our portfolio, the area of the portfolio where we try to make a bigger alpha and have a bigger return on the portfolio, is we will compare ratios of different asset classes. And if we look at gold compared to the S&P 500, again, back in the 70s, if you recall, the S&P 500, the chart I showed about 10 slides back, went flat. It had a stagnating time period from kind of the mid 60s all the way to 1982, a 16-year period where the S&P didn't do well. But in that inflationary time period, gold did phenomenal. And so if you take gold divided by the S&P 500, it significantly outperformed. If this line is going up, gold is outperforming the S&P 500. If the line is going down, the S&P 500 is outperforming gold. So you can see here, then you have the 2000 run where it outperformed the S&P 500, and then the S&P 500 really from 2012 all the way till about 2025 outperformed gold. However, there's been a significant trend break here where it could show that we may go into another kind of secular time period where gold could significantly outperform S&P 500 over the long term. Obviously, no one knows the future, but if this trend kind of repeats itself and alternates between gold outperforming the S&P 500 outperforming, then I would say, it looks like that gold has started to outperform the S&P 500. There's one other trend line I'd like to see a break to have a little bit stronger of a conviction, which would be that one right there. But it has broken this downtrend right here, and something that we are that we've noticed even at the beginning of this year. We increased gold. We've allowed our gold holdings to get bigger, even without buying them recently. So that's something that we can, again, continue to think that this could be an important part of a portfolio going forward, is holding a portion of your assets in gold. And so switching gears to the bond side of things, if we look at kind of the different where the yields are now versus their 20-year, no, actually it's the 15-year average. So if you look at U.S. Treasuries, the 15-year average is 1.6. Remember, we're coming out of a very low interest rate environment. Well, now it's up at 3.9. It came down from its high from a couple of years ago, but still attractive compared to its long-term average. Same thing with municipals. This is the after-tax return of 6.2%, or after-tax yield of 6.2% versus its average 4.2. All of these you can see investment grade you have MBS, you have commercial mortgage-backed securities as well, mortgage-backed securities, all asset-backed securities, and even well, these would be all the U.S. ones, significantly higher than long-term averages, and we still believe they're attractive. And then even from a European standpoint, and looking at international bonds, not as high as the difference between their average between where they're at now as the U.S., but certainly still some attractive yields out there. Emerging markets done phenomenal. It's still a 7.1% yield. And then this is the local currency, emerging market corporate. And then this would be one of your most kind of volatile areas, which would be leveraged loans at 8.3%. But this is the area I want to focus on from a bond standpoint, that we still believe there are attractive yields to be had out there. At the same time, bonds serve a very important purpose, especially U.S. Treasuries, government bonds like mortgage-backed securities. That's what we're focusing on in our portfolios, and that's an area where that is typically non-correlated to the stock market. Not in all cases, it wasn't the case in 2022 when you had really high inflation. But over history, if you look at some of the big bear markets, government bonds have gone up. 2008 is a great example. When the market went down 35% in 2020 during the pandemic, that's another good example. But where you have U.S. bonds go up as a flight to safety when you have the stock markets go down. So it's a non-correlated asset that's very important to hold in your portfolio. And we're focusing in on kind of the MBS side and Treasury side. That's going to be your safest area. And they still offer pretty attractive yields right now. All right, so where do we expect the Fed to go? There's kind of two ways to look at this in terms of where the Fed, where the Fed is saying that how many cuts that they're going to have. The kind of FOMC projection, which is the red line here, and then what the market, based off kind of futures, where the market expects the Fed to go. The solid line is where the Fed, what the actual short-term rate has been at, and you can see it's gone down. It's projecting right now to have 2 more rate cuts before the end of the year, and that is the case for both the FOMC projection and the market projection. So there's a very high likelihood that over the next 2 Fed meetings, we have 2 more remaining this year, there'll be a quarter point rate cut in each one of those meetings. But then that's when you diverge a little bit. The market expects to continue to have rate cuts as we kind of go into this next year, kind of at the same pace. And I think that it ends up being 3 more rate cuts. But the FOMC is kind of seeing them as slowing down a little bit. And you have a couple of things that are kind of going up against each other. You have the jobs picture, which is weakening, and that would show that we need to have more rate cuts. But you have inflation that's kind of leveling off and potentially slightly going higher. That kind of would probably lean to the camp where the Fed cuts, 2 more times before the end of the year, and then they pause for a little bit. So if we look at the different areas of bonds in terms of total return, not just their yield, but their yield plus what the price of the bond has gone up for multiple years, emerging market bonds have done really well, and it's up 8.9%. Same thing with global bonds. Big part of that this year, this is dollar getting weaker. If you hold, same thing with stocks, same thing with bonds as it is with international stocks. Holding bonds that are domiciled in other currencies, if you have a weaker dollar, those other currencies benefit from that. But if you see here at MBS, mortgage-backed securities, which is an area that Christina, and you guys probably heard her last week, but she recommended that we went higher MBS and concentrated a little bit more on that 3 or 4 months ago, maybe a little longer than that, and that worked out well. That's up 7.8% this year. It's an area that we've been adding to this year, and you can see some of the other areas: investment grade corporate bonds, TIPS. Treasury inflation protected securities continue to do well. This is another component of our bond portfolio that we do hold. There is a chance that you have higher inflation, especially with tariffs and higher deficits, that you could potentially have inflation. There's even potential talk of quantitative tightening starting to slow down, which could be inflationary. So we do feel it's important to have some Treasury inflation protected securities. So these are basically bonds that are linked to the CPI. And so if inflation goes up, these bonds typically do better. Whereas you like treasury bonds, when inflation goes up, bond prices don't do as well. So that's been a good performer this year. Long-term treasuries, all of them are doing pretty solid across the board here. And here's the money markets have started to come down some as interest rates have come down year to date. They've only done 3.3%. So, a couple years back, people were wondering like, hey, I'm getting 5% in my money market. Why would I invest in a bond that takes on more risk? And it's because when interest rates come down, then bond prices typically do go up. So if you're buying a bond when interest rates are going down, you can typically do better in bonds rather than holding money markets. And we believe that will still continue to be the case going forward. All right, so if we look at, some people have mentioned that it feels like the economy is slowing down, and they point to the jobs market, and certainly jobs have slowed down. But if we look at the GDP in the second quarter, it actually reached 3.8%. So after going negative in the first quarter of negative 0.6%, it's rebounded pretty strongly, and we're up at 3.8%, which is the highest in the last couple of years. And what is encouraging is that consumption is at 1.7%. So of the different components of GDP, consumption has stayed steady. So you have averages that go from 2000 through 2024, where consumption has contributed 1.7% on average to the growth in GDP, and that still has stayed steady even in the last quarter. What I think is also really encouraging is business fixed investment. So that's businesses investing in different components of their companies, building manufacturing plants, improving things like that. So you can see it's gone from an average of 0.5% to it's actually gone up to 1%. Part of that could be this kind of push to manufacture goods in the US. And they're having to, companies are having to build bigger manufacturing plants, improve manufacturing plants to avoid some of these tariffs and produce more in the US. But both of those, if we look at those, that is, so the consumer is still steady and business fixed investment has gone up. So that is encouraging with the economy. Now I know it is looking at the second quarter, and we're just started the fourth quarter, but that's a trend that we continue to watch and monitor. There's other ways that we follow the strength of the consumer and look at CapEx and things to kind of see how the economy is doing. And so far, it still seems to be pretty solid. All right, so here's another kind of one way to look at the jobs picture. So if we look at job openings per unemployed worker. So if we go back to 2002, kind of this 23-year average or so, it's about 0.73, meaning there's 0.73 jobs open for every unemployed worker. And that did peak in I think that was around 2022, where you had 2 openings for every 1 person looking for a job, and that causes wage inflation. So if there's 2 job openings for every 1 person looking for a job, you're going to pay people a lot more in order to attract them to come to your company. Well, now that isn't the case anymore. So that actually helps inflation. At the same time, because there's less job openings compared to the unemployed worker, well, people may be concerned that that hiring is slowing and that we're going to have a difficult labor market, and that could be the case. It is still trending down, but I do want to point out that it's still above that long-term average. So we still have a healthy job market if we're looking at this particular metric, which I think is an important one to track. And even though after this big decline right here, you can see it started to kind of not go sideways, but it's slowed its rate of drop. It's the momentum to the downside has slowed. So we're going to continue to watch that one. Another way to kind of look at the consumer and the consumer health and it's something that has been concerning to us, is looking at delinquencies. And there's delinquencies in a lot of different loans. If we go back to a very difficult time when the consumer in America had a ton of debt, the financial crisis, and we look at credit cards, for example, and the delinquencies there, We're certainly nowhere near where we were in the financial crisis. At the same time, over the last 4 years, that has trended higher. However, I am a little bit encouraged that it looks like it's rolled over and started to go a little bit lower recently. And that's the same thing with auto loans too. Auto loans were trending higher. They seem like they've rolled over as well. Mortgages or defaulting on your mortgage, that has steadily increased. However, it has started to flatten out a little bit right here. The one kind of anomaly here, which if you read up here, there is with student loans, there is deferment and forbearance, which really cloud the picture. From this whole time frame, they basically didn't report the numbers, or there was number. It was they were reported, but they were false numbers because people didn't have to pay on them during that time period. But now that everyone is having to pay on their student loans, that certainly has been an issue, and that is at an all-time high in terms of defaults on student loans. So we don't know kind of what happened here in between, other than the fact that people weren't having to pay on them. So they really didn't report. There wasn't really any defaults to speak of. But now, as these numbers start to come out, we've definitely seen that there's a lot of defaults on that. That could be a negative for the consumer, having to pay for a student loan, which they haven't had to pay for a long period of time. Sometimes when people don't have an expense like that for a long period of time, they fill in their budget with something else to spend on, and then when they do have to make that payment, it causes them to cut back a little bit in some other areas. So that is the one kind of red flag with the defaults here. But every other one, while it's been trending up over the last few years, is starting to roll over and not get as bad. So that's encouraging. One more look at the kind of inflation in general. Actually, I think I have two slides on this, but you can see that the Fed kind of wants to see inflation around 2.5%. And we're pretty close to that. I'm looking at a number of different components here, both PCE and CPI, and then core and just the headline number. Just to kind of get an overall trend of all of these. You see, obviously, this is with the high end inflation, came down a lot, and it's been kind of steadily going flat from here, but you can see a little bit of a pickup here recently. That's something that we're going to continue to monitor. There's the tariffs really haven't had the full effect on inflation over time, but the initial numbers that have been coming in, even with the tariffs, have not been as bad as what a lot of people thought, but it is something that we want to watch as we go forward here because inflation is an important factor. So far, it's not a major issue. It's still kind of hovering down towards the Fed target. I'm not sure we'll see kind of these days for a long period of time where inflation kind of went below that 2.5 period. I could be wrong, but I think we're going to see kind of a little bit higher inflation than those long-term averages. But at the same time, we haven't seen where it's starting to break out and go up at a fast rate, but something to closely watch. And these are the different components of CPI. So the big one that has been expanding recently is the dining, recreation and other services. So that to me says, consumers are still spending a lot on those kind of non-discretionary items because it's not looking at food at home here. This is looking at dining and going out to eat and recreation and that type of stuff. So if that is increasing, a lot of times that does show a little bit of a stronger consumer to be able to continue to pay those higher prices. So that's inflation looking at the different components of it. All right, I point this out. This is kind of if you have worked in the financial industry or been around the financial industry for a long time. It's called a quilt chart, very busy chart. And I think it's the last slide of the presentation. But I point this out just to show one is kind of a throwback and it's fun to look at these occasionally, but it's looking at all the different asset classes and how they've performed over each year. And what's interesting is a lot of times you'll go from being the best performer one year, like you see REITs in 2021, we're up 41%, to the worst performer the next year, down 25%. And you'll see that quite a bit with a lot of different areas that make big runs, then they have kind of big drops. If we look at kind of the longer term average, this 2010 through 2024, and we see here what has done the best has been the S&P 500, our large cap US stock. So if we were to say, hey, and kind of invest using the rear view mirror, as they say, if I want to look back and say what's done the best, and now position my money for what's done the best. And we look at the S&P 500, and that's done the best over the last 14 years. And then we go into this year and we say, well, it's not done the best this year. It's actually third place. It's still doing okay. But then if we look over here and say, okay, well, this is international and this is emerging markets, these two right here. And we say, well, that hasn't done well at all. Why would I invest in that if that hasn't performed well over a long period of time? And now those are the top two positions this year. So after having a poor performance for a long period of time, it is number 1 and 2 year to date. And I point all that out to say that you go through these kind of pendulum periods of time where you'll have one asset class really outperform for a long period of time, and then it'll switch back and it'll underperform for a period of time. I think we could potentially be going into an era where the S&P 500 on its own is not going to be what's going to contribute to the largest performance in your portfolio, as it has been over the last 15 or so years. I think you're going to potentially see international or maybe other components of the portfolio do better than the US in terms of a price performance over a period of time. That being said, we want to have a diversified portfolio and not just own any one asset class. But for those who have leaned like pretty much exclusively on US stocks, it's kind of a warning to say, hey, I wouldn't own 100% US stocks. So let's diversify and own a percentage of international, and percentage of other asset classes other than just the S&P 500. So to sum it all up and to wrap this up, gold has been one of the best performing assets year to date, and it's done well over the last couple of years. We expect with policy uncertainty, geopolitical instability, and the dollar weakening, all of those kind of tailwinds to continue to support gold as we go into the last part of this year. The S&P 500 has had a nice rebound, but international is outperforming, and the S&P isn't the only game in town anymore. So higher bond yields are certainly supportive of, we believe, kind of 3 to 5% returns over the next year, which may not seem super attractive when the S&P is up 15 and when international stocks are up 30. But when you're getting 4-5% in interest and the market starts to decline, people like bond yields much better during that time and like the stability of them. So it is an important component, especially if you're more risk averse. Or especially if you're more of a conservative investor, balanced investor, and you don't like those ups and downs in the market, that is a good thing to stabilize your portfolio, and you get a decent income too. So obviously we have the whole kind of government shutdown right now. So policy uncertainty is still elevated, which markets don't like. Valuations are high, and we do expect some continued volatility going forward. So, I would just encourage everyone and just remind people that the most successful investors keep a long-term mindset. And we get so influenced by the short-term news now that we want to adjust portfolios, or sometimes we get scared and we want to go cash. But as I showed you those secular trends, it's important to have a long-term mindset. Now we're doing our job, and as we see in this next line here, to keep your portfolio very well diversified and we're using a lot of discipline, and we're making adjustments to your portfolio, and that's going to be your best friend, having that diversified, non-correlated asset portfolio that is basically set up for a number of different events happening. If we have high inflation, so growth, we have things like gold and tips and potentially international that could do well. If we have the economy rebounds, we want to have U.S. stocks and international stocks. So if we go into a recession, we want to have U.S. government bonds and have that in place. So our portfolios are built with those contingencies, so that whatever happens in the market, we'll have something that should hold up well during that time. And so if you have any questions about the presentation, certainly feel free to punch them in. I'm going to hand it over to Paul here to wrap us up. But at the same time, if you wanted something more specific to your case, feel free to contact your advisor. If there's any portfolios outside of our management that you're concerned about, I'm not sure if they are well diversified, if they have non-correlated assets, things like that, you're certainly willing to ask us about it, and we can take a look at it and see if you should be concerned. All right, Paul.
Thank you. And I'm going to piggyback off of that to say, I know you've mentioned a lot of things, a lot of information here today. And some people say, well, you think international is going to keep going well, or gold is going to keep doing well. Well, perhaps. I mean, they're very highly valued. They've had nice runs. So, obviously, if we're managing your money, you see how we're thinking and we're watching this daily. I tell people you could do this yourself if you have the time, energy, and desire to do that, which most people don't. Okay. And the objectivity, which also becomes critical. So, everything that Jason says is great information. I always say take it with a grain of salt in terms of reacting to it, because as a financial planner, we're going to say, how does your portfolio fit into your financial plan? How much risk are you willing to take, or do you need to take? So should we take anything that Jason says a recommendation? No, not really. It's good information. It's a good backdrop for how we're managing portfolios, but at the end of the day, is it doing what you needed to do? Because at some point, we've told people go more conservative because that's what your portfolio or your financial plan dictates that you need, and you don't have to stress about it. So, all that being said, wanted to share some resources with you guys and I know we've had several questions come in, which I'm going to get to in a second here. Feel free to continue adding more questions down at that Q&A section. But, we have a blog that we have on our website and YouTube videos on our YouTube channel. We invite you to go see things. You can search for things in particular. One of the latest ones we did was the latest tax bill that came out a couple of months ago, which is very critical for some people. It changed certain limits. It changed some dynamics for charitable giving, which means changes dynamics for taxes, and also on Social Security as far as income and taxable income. So we invite you to go see the video. If not, we welcome a phone call. We can see how any of these might affect your particular situation. Um, Also, a financial planning update. Medicare enrollment is coming up. Actually, it just began yesterday, and it's open through December 7th. So this is a time when you can see all those companies that might be willing to reach out to you and have them enroll for you, etc. There's a lot of great resources out there. If you need someone to guide you on that, please let us know. Again, because of the old BBBA, One Big Beautiful Bill Act, there's tax considerations for charitable giving and small business retirement plans. You can still set up a 401k before the end of the year if taxes might be an issue, or again, charitable giving if you want to plan strategically as far as when timing might make sense for you. Open enrollment, that happens for our financial planning clients. We love to get involved in your open enrollment to see if there's any gaps or any changes that need to be made. I know it's already happening. I know Advent Health just opened theirs. Actually, theirs I think is about to close next week already. But this is the time of year to take a look at that. Make sure that you're properly covered in different areas or not overly covered in certain areas. And RMDs, for those of you that are over that age, want to make sure you take them before the end of the year. The threat is very nasty as how much will be taxable if you don't take it. So it's a time to take a look at that. We're, of course, looking at our clients' portfolios to make sure that if any of them need to happen, that they do indeed happen. And also you should be getting an invitation soon to our second annual Thanksgiving client gathering. We serve from a position of gratitude. We feel very blessed and honored to be able to do what we do for our clients. And want to take this time of year to thank our clients for entrusting us with their financial situations. It truly is a privilege for us. So we had our first one last year, and this year we're going to do it again because it seems such a great event. And we actually give gratitude to our clients, but also expose our clients to some nonprofits, local nonprofits that really keep us tuned to the ability and opportunity to also give back to other organizations. So we'll have those invitations out to you shortly, and that'll be December 2nd. Okay. That being the case, we'll move on. Again, Allgen updates. We encourage you to update your plan if you haven't done so in a while, as here reminded on the next slide. Um, what does a plan do? It helps clarify your priorities, map out long-term goals, prepare for life's transitions, make confident, informed decisions. Okay, so I'm a big advocate of planning as a certified financial planner, and it's also cool to have this tool electronically. You have an app, you can kind of play around with the numbers, you can see your forecast. If you see the next slide, it shows you what that looks like. So we encourage you to update your plan or to have a plan done if you haven't done so, because it's really a nice tool to empower you to make some good decisions. On a more personal note, want to have you welcome, if you haven't already met, our newest addition to the team, Milka Sáenz. She's our client experience coordinator. I won't read all the stuff here, but she comes to us with a bachelor's degree and spent many years in education. And more personally, she enjoys gardening, hiking, traveling, and spending time with family and friends. She'll be the nice, friendly face that most of the time you'll see when you come into the office right up front. So please help me welcome Milka to the team. So again, we're gonna get some of these questions in the last few minutes that we have here. Again, feel free to add some. I see some more have been coming in the Q&A section. So let's jump right into it. Um, our good friend Ed has always been a good avid contributor to questions, and we appreciate that because we know that he pays attention and listens to us and challenges us, and we appreciate that. So he wrote, Jason, I heard that AI is keeping the market up in the USA, but AI is hitting the wall due to high electrical costs and heavy water use and high-end computer chips supply chain. So it's not seem to phrase like a question, soon causing AI to not see major improvements for say 10 years? Question mark. I guess. What are your thoughts on that?
Yeah, so that is a valid point. And I think that's also an opportunity for utility companies. In fact, I read an article today. I mean, so just to give you guys some context, obviously, AI has a huge energy cost to it. It uses a lot of energy to run the different computer processes, the GPU units, all those things. It's a big energy drain. And so what the article I actually read this morning was that large tech companies are actually taking it upon themselves to build their own power plants, not even waiting for the kind of the public or the kind of main power plants to do it, but they're looking for ways to build their own and create their own power plants. So I think it's an opportunity. Honestly, I think it's a challenge. And it's a challenge that needs to be faced. And I was actually just looking at a chart yesterday of kind of a uranium ETF, and it's definitely been on an uptrend. And I think this is a big reason why. There's been talks about small uranium reactors where instead of having a huge nuclear power plant, you have these kind of smaller power plants that can still generate massive amounts of power. So I think and I see a lot of potential innovation on energy itself, whether it's being done at the public level, whether it's being done on the private level, or even companies taking it upon themselves to generate more power. So I actually see that as an opportunity for other areas of the market outside that's going to benefit from AI. But the point about the supply chain, certainly that's a potential issue, especially with what's going on between China and the U.S. I know there could be this time frame, maybe between the next 2 to 3 years, where if we are trying to shift over to manufacturing in the U.S., it takes a while to build that type of stuff up. But there are a lot of companies, even like an Apple, for example, that are spending a ton of money to build manufacturing plants here. And so, but plus you could find friendlier nations to the U.S. to also do it as well. But all that to say, I think everyone felt the shock of the supply chain issues after the pandemic, and since that time, countries have been doing a ton about shoring up their source of manufacturing and supplies. So I also think that creates not only a challenge but an opportunity to in some industries that really kind of benefit from helping build out manufacturing plants and moving those over. So certainly see it as a challenge. 100% agree with you that those are both challenges, Ed. At the same time, I do see it as an opportunity for other industries to profit from the growing needs of energy and the growing needs of manufacturing more locally.
Which again is a testament to having a well-diversified portfolio because not everything goes up at the same time. As one thing may falter, the other things may go up. And just as a compliance guide, this is not a recommendation to go invest in uranium necessarily, but just a point of observation from Jason. So thank you, Ed. Jason, in case you didn't see that, he said thank you for your great steady work. He appreciates it. He did have another question. Due to the high Fed debt and it continuing to rise in the future, have we reached a point where interest rates no longer really work at affecting the economy?
No, I think they're having actually a bigger effect. I kind of take the opposite side of that because if the national debt, like let's just take the U.S. for example, it's around 36, 37 trillion. For the first time in a long time, the debt service of that debt has gone over a trillion, and it's actually gone over higher than the Department of Defense, or now it's the Department of War, but it's gone higher than that. So we're spending $1 trillion+ on servicing our national debt. Well, we could have had that level of debt if interest rates were still super low. It wouldn't have been a major problem, and that would have been a much lower line item in the U.S. budget. But because interest rates are higher, and now we're having to borrow at 4.5 percent or so versus borrowing at 1.5%, I do think that has a major effect, and I think that's why the president is kind of trying to use his force to push interest rates lower, which is a debate for another time, but whether that's the right thing to do or not. But I think that's the reason, is because it does have a major effect, and it does hurt as a country, and it makes it very difficult to get deficits lower when one of your biggest line items is the servicing of your current debt. And it's a typical cycle to end, because you're having to borrow more to pay your debt or pay the debt. So at higher rates, which causes kind of this chain reaction. I think I did see one encouraging sign. It was a very slight one. We don't have it in the slide here. I would show you, but and I don't remember the exact number, but I know it was a 0.2% reduction in terms of our deficit, which is the amount of money that we're bringing in versus the amount of money that we're spending, the government spending. So how much they bring in in tax revenue versus how much they're spending. The deficit is the difference of those two. And to give it, instead of just looking at these really high numbers, you have to put it in percentage terms to really kind of understand it. And I think our deficit last year was around 6.2% in terms of deficit to our GDP. And this year so far, it's 6%. Both of those numbers are astronomically high. We want to see them lower than 3.5%. So we got a long ways to go. But the good news is it's not as accelerating as fast of a rate. So it's one little glimmer of hope there. And we'll see if that continues to be the case. I'm not holding my breath, but hopeful.
Very good. I want to be conscious of time. For those of you that have to jump off, it is 12. We've hit the hour. We'll continue going through the questions, but just want to thank you if you do have to jump off, and hopefully we'll see you soon. So that being said, I'm going to throw one at you, Jason, and as Mr. Compliance is going to say, be careful how you answer this, because we don't want to give any particular recommendations. But it says, based on what you said, do you see the viability of increasing a position in gold, or even investing or increasing an investment in, I think it was meant to say copper?
Yeah, gold, the way that we've allowed that position to be a bigger part of the portfolio is just allowing the growth of it to continue to happen. We already made an increase at it towards the beginning of it and towards the beginning of the year. And now, because it's made such a massive run, I don't like buying, and the investment management team in general doesn't like buying after a big run. So we've just allowed it to be a bigger part of the portfolio, and we're in the process right now of maybe even bumping up the percentage, which probably won't cause us to buy much more, but it'll just allow us to hold a higher position of gold without selling, because it's hitting our tolerance band on the upside, meaning it's becoming too big of a position in the portfolio. And when we do our strategic rebalancing, we would be selling gold if we didn't make the position size a little larger. So all that to say is we probably will hold a larger position in gold going forward. Copper is a little bit different one. Copper is very cyclical. So copper and silver are very different in that way, whereas copper and gold are very different in that way, because gold is more of a safe haven asset. Copper is more used for industrial purposes. So if we think the economy is going to slow down, then copper is typically a leading indicator of both ways. If it's starting to go up a lot, that's a potential leading indicator of a stronger economy. If it's going down, it's an indicator of a weakening economy. So we're a little bit hesitant on copper right now, just because there has been somewhat of a slowdown in the economy. So we haven't really put any significant money in copper at the moment.
All right. Very good. Very good. Thank you, Brian, for the compliment. Jason says, great analysis. How do you feel about the performance of some of the new values-based investing options, such as faith-based, aligned S&P, ETFs, et cetera?
It's something that we're definitely looking into. We've always had the philosophy that we want to give our clients the best net return and manage risk really well, and then encourage them from a financial planning standpoint, from a generosity, a stewardship perspective, to be good stewards and to use their generosity, whether it be the giving of money or the giving of the time and service, in the areas they feel strongest about, in the areas where they want to make a difference in this world. And so we've been big encouragers that way to really make a difference in this world. That being said, we have been looking at values-based ETFs. We do have a lot of Christian clients, we have clients of other faiths, and we are looking into those. When we first kind of started doing the research on those 5, 10 plus years ago, they just did not perform anywhere close to the S&P 500 and our other investments. However, that has significantly changed, and it's they're having a lot better performance recently. So it is something that we do have in a longer term goal of ours. We have a 3-year vision of having some value based portfolios for clients who really want to invest in those. So I'm glad you asked that question. It is something that we're watching very closely.
All right, very good. Um, let's see here. What about crypto?
Crypto. When am I going to get one of those questions? So crypto is interesting. Obviously, it's made some big runs, um, and but it's super volatile. Like our biggest issue with crypto over the years is, yes, I know it can make a huge run, but it's very highly correlated to the stock market. So in terms of a portfolio diversifier, it wasn't really diversifying the portfolio, as it would go up when the market would go up, obviously at a faster rate, but it also go down when the market went down, also at a faster rate. And there's been time periods where Ethereum or Bitcoin have been down 80%, in multiple time periods where it's been down over 70% just over the last 6 years. So it is a very interesting thing that we're looking at. I will give you, just planting a seed here, we are in the process right now of actually creating an Algin crypto strategy. True to our Algin nature of managing risk first, we're trying to build a portfolio that can take the advantage of the upside of crypto, but also have different things put in place where if it starts to take a big hit, that we can go safer in that portfolio. So we haven't got that hasn't been released yet, but just stay tuned and you'll hear more about that in webinars.
Yeah, this is awesome because I always remind people a lot of um, the challenges that people face when investing. Say, well, let's just buy and hold it. But the problem is most people don't when things start getting crazy, and we see, to the copper question, yeah, copper is up this year, but also this summer it went down like 25% in a day, so most people see that, oh my goodness, get me the heck out of here, so that's why well-diversified portfolio, how it correlates to your plan, that's your risk tolerance, all that is critical versus just, oh, let me just roll the dice. And, seems to be going up indefinitely. I got two more questions here. George, with the value of the dollar dropping and debt increasing and Biden paper printing, how does this impact investment values? I want to tie that with Dan's question. Good to see you, Dan. Do you think that this gold run is a precursor signal to a market hit with signs of financial stress of the dollar, inflation outlook of political instability, et cetera? Because they kind of encompass a macroeconomic view on what you think the market's doing.
Yeah. I'm going to take a little bit of Dan's angle here and kind of where he was asking that question. Gold, I do think it is a bit of a precursor of a number of things. One, really the lack of confidence in the dollar and the U.S.'s ability to manage their finances well and be able to control deficits and debt. So I do think gold's run is certainly that is part of it. And its gold over history has been a pretty good hedge against a falling dollar. So I certainly think that is one component of it. Also, geopolitical uncertainty. You got a number of wars that are happening. That also tends to be a tailwind for gold. Political instability, all of those instability areas are headwinds for gold. I have heard some recent chatter that the Fed is going to stop quantitative tightening, which is the opposite, as George pointed out, of the paper printing. Obviously, we don't use money printing anymore. It's actually just done on a computer, but I get your point. But if we were doing quantitative tightening after massive amounts of quantitative easing after the pandemic, now we've been tightening, which making money disappear, reducing the money to supply. That is actually that's the opposite of inflationary. But there's chatter that will soon potentially either slow down or stop, which means we'll stop kind of tightening, which is more inflationary. So I think it could potentially be a precursor to that as well.
All right, very good. Well, I think that brings us to the end of the questions. Guys, thank you so much for these great questions. We appreciate it. Hopefully, you find some of this information helpful. And as always, if you have any other questions or want to take a deeper dive into your personal financial plan or investment portfolio, we'd love to chat with you. We wish everyone a great holiday season, as the next one of these will be in the new year. We wish you well, many blessings, and we hope to see you soon. Take care, guys.
See you guys.